Hey everybody, welcome back to the program. Today Andy Rachleff is on the program. He has been a venture capitalist for 25 years, started in investing 83, 84, 85 time frame. The last venture firm was Benchmark, obviously we all know that, Bill Gurley and a bunch of other great folks over there, and now doing Wealthfront. Welcome to the program.
Thank you very much.
So tell me, 25 years in venture capital, I mean, what is the one thing you learned about making great investments?
You have to take risk. Without risk, there isn't reward.
And so unpack that a little bit for us. I mean, in 25 years of investing, when did you find yourself, what risks didn't you take that you wish you did, maybe is a good way to ask the question.
You know, my investment idol is a guy named Howard Marks, who runs a hedge fund in LA that you might know called Oaktree.
Yep.
And he's as well known for his writing as he is his returns, which are very, very good. And he once wrote an article about investing, which I think relates well to entrepreneurship as well. And in the article, he posited that investing can be explained with a 2x2 matrix. On one axis, you can be right or wrong, and on the other axis, you can be consensus or non-consensus. Now, obviously, if you're wrong, you don't make money. Right. But what most people don't realize, if you're right in consensus, you don't make money. The returns get arbitraged away. So the only way as an investor and an entrepreneur you make outsized returns is by being right in non-consensus.
So basically, you have to have the courage of your convictions in the face of everybody else disagreeing with you.
Exactly.
Which is, of course, scary.
Yes, which is why it's not for everyone. The funny story is, you know, one of the companies Benchmark is well known for is eBay.
Yeah.
And I can tell you that until it went public, all of our peers in the venture industry thought we were silly.
Yeah.
They would say, Beanie Babies? Come on, this isn't a real business. So you make bets, and you have to be willing to be wrong a lot. And it's one of the few industries I know of where you can be wrong 70% of the time and be brilliant.
That is true. The majority of startups fail, which means the majority of venture investments fail.
I wouldn't say fail. They don't make a big return.
Okay,
so I would say there's a two-tiered market in venture. Right. 2% of the firms generate 95% of the industry's returns. Wow. And among those 2% or 20 firms, I would say the complete loss ratio is maybe 20 to 30%. So it's not the majority fail. It's that the majority don't necessarily make big returns.
Yeah, just sort of a push or something.
Yes.
And stuff like that. So in the 80s, venture capital is much different. It's a much smaller pool of potential people you could raise money from and a much smaller pool of entrepreneurs. Is that correct?
Not necessarily. It's a very cyclical business. So there was a cycle from 1980 to 1983 that looked a lot like 1996 to 1999, only an order of magnitude smaller on every dimension.
Right.
So more companies an order of magnitude more companies went public in the 80 to 83 time frame than had previously gone public, just like an order of magnitude more companies went public in the bubble years. An order of magnitude more venture capital firms were created, an order of magnitude more capital was raised. And so the exact same dynamics happened. And when the window shut on the IPOs, all of a sudden there was a big contraction in venture capital. So after, from 1990 on, we haven't really seen the kind of contraction that we did in the mid-'80s to the late '80s.
And what was it like in the 80s? It was mostly packaged software, operating systems, computer companies, Eagle Computer, HP?
Well, it wasn't much software because people thought the assets walked out the door every night. Early in my career, I started investing in software, and that was considered very unusual and risky. So Silicon Valley was really built on semiconductors, computers, and storage. Right. And software started really gaining steam around 1990 as an investment opportunity.
And what was it that made software break out at that time, do you think? Was there like a company that sort of let it out of this sort of morass? Was it Lotus or just that?
It was the wave of Microsoft, Lotus, WordPerfect.
Sure. Quattro Pro, whatever. All those desktop computers getting out there. And when you look back on the dot-com boom, what do you think the lessons learned there were?
Well, I think everyone knew what was going on. We were
Yeah.
playing the game on the field. And the funny thing is that had you not played, you would have been worse off. Even with the crash,
Right.
you would have been much worse off. And so all the intelligent people knew what was going on, and it was sort of a momentum game.
Right.
The question is, could you stop in time?
And do you feel we're in that now? I mean, you start to see the Facebook, Twitter, Pinterest. Well, I mean, Facebook's now public, so it seems to that seemed to have hit a wall. You know, it wanted to go out at $42. It started banging around in the teens. I mean, have we learned something there, and that's why Facebook sort of hit this wall?
You know, there's a great debate in The Economist between Ben Horowitz and Steve Blank,
Sure.
where they discuss this exact topic. And I came out on Ben Horowitz's side, which was, unlike the bubble, we're building really great companies in this environment. So are companies valued very highly? Yes. But you didn't see multi-billion-dollar companies created
Right.
back then the way you do now. So one thing that has been true through my entire career is that the best companies are overvalued
Right.
by standard metrics. So I don't think a bubble is an environment where things are valued highly. I think it's an environment where crappy companies are valued highly.
Yeah. So the companies are valued way disproportionately to the actual value they're providing.
Yes.
The revenue.
And so we have a lot of companies that are valued at arguably absurd values, but they're real businesses. You know, if you look at Airbnb and Dropbox and Square, these are going to be multi-$100 million businesses.
And when you say multi-hundred million, you mean in revenue?
That's
and
all I
profits?
care about.
Yeah.
I don't think about market cap. I think about revenue and profit.
What were the big misses of your career? The what we call, I guess, in the business now, the anti-portfolio.
Oh,
when
God.
you look back, what's the gut-wrenching misses? I mean, did you have an opportunity to invest in Apple or Dell?
No, but I did in Cisco.
You did in
Cisco
Cisco.
Systems, yeah. So
Wow.
both of those.
And what would have been the valuation of Cisco then, and when you could possibly have exited or something?
Thanks a lot.
Yeah,
for
it's just,
bringing-
no, I mean, I think
this
it's
open
like,
wound.
yeah, it is.
I would bet it was, Cisco, we along with probably another 50 some odd firms turned down the round that Sequoia did.
Huh.
And that probably valued the company at $10 or $12 million.
Wow. So they wound up putting $2 or $3 million in. And
$2.6 million.
you don't forget these
I
numbers
don't
for
forget those
30%.
numbers. Because, the funny thing is,
And they own what, 30% or something, you think?
they owned approximately 30%.
Wow. Of a company that ultimately was worth hundreds of billions.
Well, but they didn't hold on to it that
Yeah,
long, but it was an amazing return.
12 million to 12 billion maybe. Something like that.
Exactly. So you remember the ones you miss.
Yeah.
Because
Well,
you can
thinking back
only
on
learn,
that,
you
had-
can only lose one
yeah.
times your money. So
Right.
you can't worry you feel badly about the people who are in the companies.
Sure.
But when you think about returns, you're much more focused on the ones that you missed and learning from those than the ones that failed.
Right. And what was the signaling, or what was the miss on Cisco? How do you miss a Cisco? John Chambers walks in.
Well, it wasn't John Chambers.
It wasn't John Chambers.
The two
Oh,
founders.
right. The two founders were professors, or
Well, no, one, they both worked at Stanford.
Right.
And one of them, I went to Stanford for graduate school, and I now teach at the graduate school of business. And so one of the two founders ran the computer center at the business school, and she was the nastiest human being I had ever met.
your time is up on that computer.
So I made a.
This is back when people rationed computer time.
It was a mainframe. It was a
Yeah.
DEC System 20
Yeah.
mainframe.
That was not an easy job to have.
No, it wasn't, but you didn't have to handle it the way Sandy Lerner did.
Yeah.
So I got overly that. And if there is a huge lesson that I learned in the venture business, is that you shouldn't get overly sensitive about the personalities of the people. You have to focus on the product market fit.
Right. And in fact, is it true in your experience over decades of this that the personalities who do create great things may not be all that affable?
More often than not.
I mean, it's almost like the people who are affable maybe don't make the great
That's what
companies.
That's what the stats would say.
Yeah, pretty clearly.
But that doesn't mean you have to be that way. There are a lot of young people now who want to be like Steve Jobs, thinking that that's what you need to do to be successful. I don't
so
think
it's correlation and causation?
Yeah, I think there's an attribution error there.
So explain that to the audience who didn't follow what we just said.
I don't think you need to be a jerk to succeed,
Right.
but many of the people who succeed act like jerks.
Got it. And when you look back on Steve Jobs, obviously being in the Valley for so many years, you must have met him or interacted with him a number of times. What's your take on him? You know, obviously built great companies, Pixar and Apple, and Next.
Although I don't think he really had that much to do with the success of Pixar.
No, he was a lot.
In hindsight.
He bought the right company.
Well, the funny thing is the real story was he bought the company for RenderMan's software.
Right.
Because he thought 3D rendering software was going to be a really big deal. And I think he bought it for $35 million.
From Lucas.
Right. And he put something like $60 million in to fund the losses. And
Lost $100 million.
Lost it all. And he basically said to the team, that's it, I'm done.
Right.
Fend for yourselves.
Right.
And the only way they could fend for themselves was to start making commercials with this software. He didn't drive that strategy.
Right.
It was necessity.
It was his jerkiness that drove it.
Well, he wasn't a jerk because
He had lost $100 million.
He had lost $100 million and there was no product market fit.
Right.
And it forced the people in the company to do something out of the ordinary to stay afloat.
Got it.
And that was to do commercials using their software.
Right.
And I think they did a Lifesavers commercial, which was an enormous critical and commercial success. From that, they made a short movie.
Right.
From that, they won the Academy Award, and then they became
Pixar. Right.
And then Steve jumped back in to make the most of it.
Got it.
But I don't think he had the same impact that he did at Apple.
Interesting. And when you look back on his career, did he pitch you on Next? Did you ever meet him during that time period?
He didn't want venture capital.
He didn't at that point. He was off the reservation. And
I don't think he was off the reservation.
Yeah.
I think that he could command valuations that venture capitalists wouldn't pay.
Interesting. He was that good that he could just say,
Absolutely.
I'm going to get whatever money I need from Wall Street or some alternative. Individuals, Ross Perot.
His own money and what was the founder of EDS?
Yeah, I don't remember.
Ross Perot.
Ross
Perot funded him.
Right. Interesting.
And I think Sony or some Japanese companies as well.
Yeah. And so you left venture capital after 25 years to start a company.
No, I actually
no.
I retired from venture capital to teach at Stanford.
That was the
idea.
And why? I mean, why leave such an amazing business? It seems like it's the greatest business ever. I mean, not that teaching is bad, but what was your reason?
It was wonderful, and I loved it. But one of the wonderful things about Benchmark and one of the unique things about Benchmark is it's an equal partnership. And amazingly, given the success of the firm, no one has ever copied us. Yeah. So there might be equality among the senior partners, but not everyone.
Right.
And so even if you join 17 years after the founding, you're an equal partner.
Wow.
Well, the only way...
What does that mean? That means if I were to join next year and Bill's like, hey, Jason, we play cards together, you're a great guy, you want to join the firm, I'm going to make the same amount as Bill Gurley?
Exactly.
Well, that makes no sense.
It sure has worked for them, hasn't it?
But it has worked pretty brilliantly. So what's the thesis there?
The thesis
And you were part of that thesis?
I was part of that thesis.
Yeah. So what is the thesis?
The thesis is it allows you to attract better people. Because if someone's a superb potential partner, would they rather join us as an equal partner or another firm as a junior partner? Well, if they're truly superb, they don't want to be junior in the hierarchy.
Right.
So it allows the firm to attract people like Bill, who came in after the original five, Peter Fenton, Matt Kohler. These are tremendous people, arguably better than we were.
Yeah.
And that's what allows us to build a firm that sustains.
Interesting. But that means the people leaving, these venture firms, when people leave these venture firms, do they own the venture firm? How does it work? Like, I don't think the audience understands. Who owns Sequoia or who owns Benchmark?
Well, different firms operate differently.
Yeah.
But most firms, the partner has a stake in a partnership.
Got it.
Okay? So, and you vest that stake like an entrepreneur would vest equity, except it vests over 10 years or 12 years, not 4 years like entrepreneurs do. And so if you choose to leave a firm, typically, or if you're asked to leave a firm,
that happens too.
That happens too. Then you will get what you vested in ownership in the carried interest in the percentage of the profits for that particular fund.
Right. So if you're on benchmark 7 and you've done benchmark 3, 4, and 5, and you've done 75% of your time in each, you have 75% of what your carry would have been.
Exactly. So the only way that
Seems fair.
The only way that you can make this work, an equal partnership, is not to have the old guys suck up the equity and not work very hard.
Right.
Which is what's common in the investment industry. The founders become old guys. They don't want to work as hard, but they want to keep getting the VIG, as you called it before.
The VIG, right.
Exactly. And we had experienced that ourselves. We were young guys when we started Benchmark. We were all in.
You were working at another firm.
I was working. Well, I was at a firm that decided to wind down, that would not raise another fund, and we decided the only way that we could make this work is that if you were not willing to go 110%, you had to raise your hand and opt out of all future equity, but you would be fully vested in the funds in which you participated. Right. So having helped create this system, I believed in it firmly. Right. And I benefit from its legacy. If Benchmark does well, that reflects well on me and my legacy in life. Right. And so I get no equity in future partnerships, but I'm allowed to invest in the funds. Right. And I think that's a great deal. And that way, when I go to Benchmark to visit my partners, they smile at me instead of gnash their teeth and say, well, why is this guy coming to the office?
That guy is taking the VIG. He's here to collect the VIG, get the envelope, and get out.
Exactly.
As opposed to, he's an LP now. He believes in us so much, he gave us control and all that kind of stuff.
And it makes enough equity available for great guys like Matt Kohler and Peter Fenton to join the firm.
And what makes a great venture capitalist today? I mean, and what makes a bad one? Yeah, you think?
This is controversial, but I believe that 90% of the value added of the venture capitalist is making the right investment decision.
The selection.
The selection. Now, I'm pretty proud of my contributions as a board member, but I think my contributions might have taken what was a 3x return to a 6x return. That may be through the people that I recruited or the perspective or the network, I could have helped the company get a better outcome from 3x to 6x. That doesn't move the needle on the economics of the fund, surprisingly. Just like everything in life, there's an 80-20 to the return. So 20% of the deals generate 80% of the returns. And 6x doesn't move the needle. You need the 10, 20, 30 times your money outcomes. And so, but the ones that are the 20x outcomes are going to be great successes whether or not I was involved or someone who was less capable was involved on the board. Being a good board member might get you the next great deal for reputation, but my colleagues in the venture industry don't like hearing me say this, but I think 90% of the value added is selection.
Interesting. And so what's the bad behavior, things that make bad venture capitalists? You are on the board of all these different companies over so many years. You must have seen people just absolutely, I don't know what the word is, but screw things up or muck things up. I mean, what should an entrepreneur be wary of? I mean, what's the damage a VC can do?
Yes. Go-to meeting. This morning, I was on a go-to meeting with one of my investors in Mahalo, soon to be Inside.com. And they were like, oh, well, what about this? And what about that? Can you show me some of the stuff you're doing for your new project, Inside.com? And I was like, oh, as a matter of fact, I can. Let me log into my intranet securely. I didn't have to give them all the passwords and send them to like all these special URLs and IP addresses. I just shared my screen, and he was in Germany. And I was sharing the screen with him. His day was ending. My day was beginning. And I just instantly put on my headphone, perfect voice over IP, crystal clear, perfect HD faces, and perfect screen sharing. Go-to meeting. I start the meeting on time every time. Use the HD faces. Works great. You can use your iPad. And I used that recently. And you guys may remember in the episode where I was talking about the live crowdfunding app, I was actually using my iPad mini as a camera to view logged into GoToMeeting to view an iPhone. I mean, this is getting crazy. It's like, however you think the product should work, GoToMeeting makes it work. So thank you to my friends over there at Citrix. Meeting is believing, and you can try it free by going to GoToMeeting.com, click the try it free button, and click the promo code TWIST. GoToMeeting, meeting is believing. And we ran this contest to give away this very awesome, oh look, it's got the new lightning adapter too, this very awesome iPad. Gorgeous. Because you can do it. And I said, hey, where would you like to do your meeting? And these are the top two. I would like to host a GoToMeeting while waiting in line at Disneyland. That's a good one. I like that, Chandra. And then Lynn said, I would take a GoToMeeting in Central Park in New York City on a spring day, a beautiful spot in a wonderful city. See, now that's a good one because she's pandering to my New York City roots. But Chandra, on the other hand, is pandering to the fact that I was at Disneyland with my daughter recently, and I've been spending a lot of time with Disney princesses. This is going to be very hard for me to pick. And gosh, I'm going to go with Chandra, actually, because you know what? I've been online at Disneyland a lot these days, and then they said for some godforsaken reason I need to sign this. I guess that people want my autograph on the back of an iPad, which is great. And it says, hey, This Week in Startups winner from your friends at GoToMeeting. So congratulations to Chandra, and I will say, what should I say? I never have to autograph anything. Who am I? Bono? I'll get an autograph of an iPad? It's ridiculous. I'm Steve Jobs. What should I say? I'll just sign it. At Jason. And I'll put congrats. At Jason. There you go. Look at that. Now I've ruined your iPad. No, it's great. Every time Chandra uses the iPad, he can think of me. And GoToMeeting. Meeting is believing. Thank you, GoToMeeting.
They almost can't muck up a good company.
Yeah, they could try, but they can't.
They could try, but they can't.
Right.
Because I think product market fit overcomes everything.
Product market fit overcomes everything.
And this is a course that I teach at Stanford about the importance of product market fit to the success of a startup. If you address a market that really wants your product, if the dogs are eating the dog food, you can screw up everything in the company and you will succeed. Wow. Conversely, if you're really good at execution, but the dogs don't want to eat the dog food, you have no chance of winning.
Interesting. What's an example of that? Or what are examples?
Name a franchise technology company.
Google search.
That was not a terribly well-run company.
Yeah, in the beginning. eBay.
Not, very poorly run.
Really?
They screwed up a lot of things.
PayPal. Disaster, right? Fraud, everything.
But if people want the service,
it's going to succeed.
It's going to succeed. So if you believe, as I do, that management's job is to get to product market fit as opposed to execute, then they almost can't. In the early days, even if they screw up, they can succeed. If you're a horrible director, you're not going to stop the company from succeeding. Now, they can be used as an excuse for a company that isn't succeeding, that they got in the way.
Right.
I don't buy that.
Yeah, exactly. And so Wealthfront, what is it? Why'd you start it?
Why did I start it? Well, over the years, many of the people that I recruited to my portfolio companies and many of my former students, I've been teaching for more than 8 years now, would come to me for investment advice.
Right.
And I could never tell them to do what I do because I'm in the fortunate position to be able to afford access to the best investment products and services. Right. So they couldn't afford the minimums. So I could never tell them to do what I do. Right. And that always struck me as wrong. So after I retired, I went on the board of trustees of my undergrad alma mater, University of Pennsylvania, and I'm on the endowment investment board. We have a $7 billion endowment at Penn. And I learned more, and I knew the people who ran all the premier endowments because most of them were investors in Benchmark, and I knew them from the venture community. And they all invest basically the same way. And one day I was sitting in the meeting, and it struck me that, through software, that some APIs started to become available that could make that style of investing available to the masses. And so I didn't want to start a company. It found me, and I did it for the social good to try to democratize access to sophisticated financial advice.
And what is the sophisticated thing that Penn has that just a person on the civilian on the street doesn't have? Is it the information? Is it the structures? Is it the
Well, there are a
the
few
funds?
things. So the great endowments, number one, understand how to do an asset allocation. They understand, meaning how do you divide your money up among diversified styles of investment that are uncorrelated? How do you rebalance? And then within each of the classes of assets, like stocks and bonds and venture capital and private equity, they can figure out who the best managers are. But if you just do the mix of different styles of investments, like the mix of your stocks and bonds and real estate and natural resources well and rebalance, that's 80% of the value. And most individuals can't do that.
So,
Or if they can, they have to pay a very big fee to get that advice.
what's a very big fee? 1-2%?
So if you go to Goldman Sachs or Morgan Stanley Private Wealth Management, you need $5 million, to get them to manage your money,
Right.
and then you pay 1 to 1.5%. Now, we have combined some of the most sophisticated experts in the financial world. Our chief investment officer is Burt Malkiel, who wrote A Random Walk Down Wall Street, which helped create the whole index fund trend, with sort of the best of Silicon Valley's engineering to deliver the same service that Morgan and Goldman deliver at a $5,000 minimum and at 0.25% fee.
So somewhere between, so either 15 to 25% of the fee and a fraction of the minimum.
3 orders of magnitude lower.
Yeah. So I can go in there, take $100,000 and have it balanced and rebalanced over time and just model myself like a Goldman professional might.
Exactly.
And you educate me, or I just set it and forget it, or both?
You just set it and forget it. So you come to our website, you answer a 10-question questionnaire so that we can determine your tolerance for risk. We don't ask you for your risk tolerance because behavioral economists have shown that we all overstate our tolerance for risk. And if I give you a portfolio that has higher risk than you really are comfortable with, it's likely to be more volatile, and therefore you're more likely to sell in the bad times and leave a lot of money on the table.
So if I bought 100% of my money in stocks, when 2008, 2009 happens, it goes down 50%.
You're going to run for the exit at the wrong time.
At the wrong time.
Exactly wrong time.
Yeah.
So we've taken a lot of research from behavioral economics to develop a questionnaire to determine what your true tolerance is,
Right.
which is the critical input into something called modern portfolio theory, which is the basis on which endowments and other sophisticated institutions manage their money. And then we periodically rebalance it. Now, if that's for $5,000, if you give us $100,000, we do something called tax loss harvesting, which was one of the 2 ways that Mitt Romney kept his taxes down. But this has only been available to very wealthy people. We're bringing it down to people with $100,000. And that alone adds at least 1% to your annual after-tax return. And then we're about to introduce a new service where we give you a different mix for your taxable account or your retirement account. And by doing that, we add another 0.5%. So what's really cool about what we do is because we're a software-based financial advisor, it constantly gets better, whereas a physical financial advisor stays the same.
It doesn't scale all that well.
It doesn't scale.
Yeah, it's sort of like you buy the new Tesla Roadster, the new Tesla Model S, you get new software every month, and the car just gets better and better, even though you're not paying any money.
Exactly. And so with us, you get more and more features and arguably more net of fees after tax return, and we don't increase the fee.
And so what's the most somebody's put to work at Wealthfront? If somebody come in and said, here's $10 million, go?
Well, we have a range of $5,000 to $5 million.
And so have you had people put $5 million to Wealthfront?
Yeah.
Really?
Yeah.
And so if they put $5 million, then that means they probably have $50 million or something else, or $20 million. Are they trusting you with the whole nest egg?
Well, we have applied a Dropbox-based business model to financial services for the first time.
Right.
So the way it works is just like Dropbox gives you a certain amount of storage for free, and then they charge you. So we manage your first 10,000 for free, and then only charge 0.25% thereafter.
Right.
And for every person you invite, you and they each get an additional 5K managed for free.
Right.
So if you invite 10 of your friends who join,
Or family members.
that you'll have 60K managed for free. So what we tell people to do is, hey, try it with $10,000 and see how you like it. It's a freemium
I'm just thinking
model.
right now, I pay 1% to my money manager. I'm kind of in that situation you're talking about. I was like, wait a second, it's 75 basis points compounded.
Oh, it's enormous.
It's 10% or something after 10 years.
After 20 years, it's about 35% of the amount of capital you invested.
Oh my God.
It's an
Killing me.
enormous number.
Yeah. I mean, those fees just seem so small, but then...
So that's just the low fee. When you start adding our sophisticated services like tax loss harvesting and optimized asset location, it gets even better.
And what kind of support do you get? I mean, obviously, your money manager takes you to a Knicks game or something, and
I'm sorry you don't get that.
You don't get that. You don't get to go to a Knicks game or go to a fancy lunch.
No.
What if you need support or more understanding of what's going on with my money? I read the website, read the blog.
Well, we try to make the product so simple that it answers all. We're completely transparent, which has never been done before.
Yeah.
And we try to make it so simple that you don't have questions. But if you do, we have financial advisors to answer phones or emails. Interestingly, no one calls. Because we've targeted our service initially at young people who work in tech who can't yet afford the minimums of a financial advisor.
So they've got $250,000 they got in some stock or $500,000. Like, I don't have time for this. The Goldman guy doesn't have time for me. I'll just put it here in Wealthfront.
And what most people don't realize is that about 80% of the individual investor market is made up of delegators, people who want somebody to do it for them.
Yeah.
Only 20% go to E-Trade or Schwab and trade their own account.
Well, I've been thinking about this myself. I know how the portfolio should be set up. I've read about, allocation and stuff like that. I mean, not to the level that you guys are doing it, but it's based on the 1% fee, you could just buy these indexes or these devices. I mean, is that what you're doing, is buying these devices? Are you actively managing the stocks, or are you just saying, hey, here's the NASDAQ QQQQ, which is by a certain
buy
percent?
it. Well, we
Do you actively trade, I guess would be the way
no,
to say
we
that?
don't actively trade.
Right.
We allocate your portfolio. We custom allocate for your risk tolerance across 11 different asset classes, each represented by a low-cost ETF.
Got it.
So the average ETF costs only 0.14%.
Really?
Yeah.
I didn't know that.
And so we keep the cost way, way down, which impacts your returns net of fees and after tax.
Interesting. And so this company was invested in by a lot of famous people. I know Mark Andreessen and Bill Gurley. And when a venture capitalist needs to raise money, you have pretty high credibility. You just go to your friends and say, hey, I'm starting something? Or you have to pitch them?
Well, they came to me
Ah.
because they said, what are you so busy with?
Yeah.
Because they were wondering why I either couldn't go to lunch or play golf with them. And they knew that I was teaching, but they didn't know that I had started this company. And when they heard what I was doing, they got interested in the idea, and they said, would you take some of our money? And that's how we originally got financed. So it's let me tell you, that's unbelievably fortunate.
Yeah. And now, how many people at the company, and what's the trajectory?
A little more than 20. Well, we don't yet disclose our assets under management, but they doubled just in the last 3 months alone.
Wow. And how do is the idea of you're not going to be actively out there trying to find people, just people will tell their friends in the Dropbox style?
Interestingly, in January, more than a third of our new clients came from our invitation system.
Huh. Fascinating. So that's another cost savings that gets passed on to your people. You don't have to sponsor a golf tournament.
Well, the only way that we can charge such low fees is by driving the marginal cost to open a new account to zero. Because if you think about it, if you go to Morgan or
There's
Goldman...
not enough money there for you.
Right.
If you're only making $2,500 off me a year.
Well, that's if you have $1 million.
Yeah.
Well, at Morgan and Goldman, they have to hire a lot of support people to answer the phones, to call you, every month. In our case, you open an account online, you fund it online, and then we trade it electronically. So most people don't ask for support. So arguably the marginal cost is zero, which is how we can drive the fee down so low. It's a classic disruptive business model.
How many different... I mean, you said I answer these 10 questions and you can tell me what my risk tolerance is. What if I look at that and say, you know what? I think my company's doing pretty well. I'm going to have a good exit. I want to amp up my risk in my portfolio so I have more money to spend.
We allow you to do it, but we warn you.
So
literally, there's a warning that says, you understand this is really higher risk than you should tolerate. But we treat you with respect.
You can dial it up.
You can dial it up or down.
Are there settings like there's like 1 through 10 risk, or have you like sort of created a system that it's easier to understand? Like there's 10 ticks of risk.
There are 20 ticks of risk.
Huh? Is anybody dialed up to 20?
No. Well, some people have dialed. Well, we increment it from 0 to 10 in half-point increments.
Okay,
so some people have jacked it up to 10.
Wow. So those people are. So how many people? What percentage of people screw around with the knob? Or is it they just trust you on the quiz?
70% trust us.
Interesting.
15% dial it down and 15% dial it up.
Really?
And interestingly, younger people dial it down and older people dial it up.
Because they want to get more money to retire and enjoy life.
I guess. And they shouldn't do it, but that
should be the opposite.
It should be the opposite.
I mean, isn't that what happened in the last financial crisis? A lot of people were going for their retirements. They got crushed when the market got cut in half. So the market Dow's at 6,000 or something. I don't know where it bounced to the bottom.
I don't remember.
It was like around 6,000. It's like 6,000, right? So people lose half their money, half their money in stocks, and then they think it's going to go down another half. So I've got to preserve capital here and move into cash.
Well, there's a very funny dynamic, a consistent dynamic among individual investors, in that they only buy after the market has gone up, and they sell when the market goes down, which is the exact opposite of what they should do.
Right.
And there's an organization called DALBAR, D-A-L-B-A-R, that annually publishes an analysis of this behavior. And they've found that on average, people lose 5% of return per year because of this behavior. If they just left it alone and didn't touch it, forget rebalancing, which adds even more return for the same level of risk, it costs you 5% a year.
Ugh.
So
nauseating.
So the beauty of rebalancing is it's forced contrarianism. Rebalancing says that if a particular asset class has gone up by too much,
if you succeeded,
then you should sell, and if you failed, you should buy. It's the opposite of the human nature.
Yeah, try to get that going.
Well, we do that for you, and that significantly improves your returns.
Awesome. Let's take a pause for a second. Is that going to be okay?
It happened in the last one and it was okay.
It was okay? Okay. These are really great microphones. You could actually... Should we shut the door?
No, that actually helps with the echo.
Oh, okay. Interesting. Okay, so then it's fine. What is that, the air conditioner?
Yeah.
Oh, all right. Well, there you go. So what's your take on the state of the economy, right? Everybody thought the world was ending back in 2008, rebounded, and then everybody thought it was ending again. It just seems like the economy is resilient.
First of all, I should say I'm no economist.
Okay.
And anyone who
You're just building a wealth management company.
But the funny thing is, the premise behind what we're doing is the economy doesn't matter. So modern portfolio theory, this methodology that most successful institutions manage their money by, which won the Nobel Prize in 1990, basically says you don't look at the economy. You look at, for each asset class, you look at the expected return, the expected volatility, and the correlation with the other asset classes. And based on that, you get a diversified portfolio of ideally anti-correlated investments. And so we don't worry about the economy because if stocks go up, then bonds will go down. Or if stocks go down, then maybe real estate will go up. And it all balances itself out, so you don't have to worry about that.
And there's not a moment in time when everything goes down.
Or
is that very rare?
It's extremely rare, and it happened in 2008.
That's when everybody was just, is that what set the panic through the market? Is that
absolutely everything? The term in the financial markets was the correlations went to 1. So correlations among investments are evaluated on a scale of -1 to 1. And so when the correlations went to 1, that really screwed things up.
It means that every time a bond goes down, the stock went down, the gold went down.
That's what was reported. Yeah. Actually, bonds went up.
Yes, you know what happened
Bonds
to
went
me?
up 4% in 2008.
I went out of stocks in like 2006 or 2007 because I was getting nervous about it. And I said, put everything in bonds. I don't want to think about it because I see all these signs of like all those problems, and I made 5 and 7% those 2 years.
So,
Then
exactly.
the market, collapsed, and then when the market hit like rebounded from like 6 to 9 or 10,000, I was like, I think the stocks look pretty good now. Let's move in.
Well, you're a great market timer. Very,
my
very few
broker's
people.
like, you beat us.
Very, very
He's
few
like, I don't know
people.
why. He goes, my market guy at AllianceBernstein said, I don't know why you're using us when we should have been following you, in all honesty. And I was like, well, thank you for that, but I don't know exactly how I made that sense. But it was actually based on this idea that what people are doing is probably wrong.
Well,
What the
that's a
consensus
contrarian.
is. I'm kind of a contrarian, yeah.
And it's contrarians who make money.
That's it, huh?
It's the key to investing.
Yeah. This other key is crazy. I made the right decision, so now I'm reversing it.
Exactly.
I made my money off Apple shares. I was right that Apple would hit 800. Now I'm selling it.
And
Because everybody knows I'm right.
exactly.
And then it moves on. So having spent 25 years in venture capital and then starting a company, what's been the hardest, most challenging part? I mean, you were a picker to your own description, 90% picking, and now you're actually building.
Yes. Well,
A little bit harder than picking.
let me tell you, it's a hell of a lot harder. I thought I appreciated how the sausage was made in these companies because I was very engaged with my companies. Hopefully in an appropriate fashion. I had no idea. Until you work inside the company, I don't think you can really appreciate it, number one. And number two, I didn't appreciate how all-consuming being a CEO is. I was really engaged as a venture capitalist, but I could go out to dinner with my family, I could go to a game and forget.
Yeah.
I can, as you know, running a business,
Not possible.
it's not possible,
You can't turn it off.
ever.
It
And-
invades every crevice of your existence.
Now, I think people were meant to either be investors or operators, and many people now come to me for advice as to which they should do. I think I was meant to be an investor. And so I got
So
us
honest,
so
dude.
I got us to a point through some luck and hard work to product market fit, and our business is now really exploding. But I was
You need a
fort-
CEO.
we need a CEO. So we just recruited Adam Nash.
I was about to say I'm not available. I love the idea.
Thank you.
But I'm not available.
Well, we just recruited Adam Nash, who was the VP of Product at LinkedIn.
Oh, wow.
And then
Winner.
an EIR at Greylock to
Winner.
be our COO, and hopefully he'll be the CEO by the end of the year.
Great.
And he in turn has recruited some superb execs that we're going to announce at the end of
So
March.
you move upstairs, you become chairman.
Where I really was meant to be.
So honest. But it's true. It is so true.
Adam's a heck of a lot better at taking us from this stage to the next than I could be.
Let's talk about founder stress and founder psychology. It's a big topic today because tragically we had Jody Sherman, a founder who knows exactly what the situation was, but he killed himself. And a lot of founders, I don't know that we have a trend in founder suicide, but we definitely have a trend in founder despair or founders being troubled, or maybe
I think that's always been the case.
it always has been, hasn't it?
Ben Horowitz, forgive me for continuing to pitch Ben, he's a
No.
good friend of mine.
Yeah, he's great.
But he writes, I love his blog.
Right.
And one of the things that he wrote a blog post about, the single biggest thing that you can do as CEO is not quit.
The number one contribution. You're an excellent CEO. Why is that, boss? You haven't quit.
Because having experienced it yourself, you
Sure.
know that there's so many times where you say, is this really worth it? But
Yeah.
you've got to persevere.
Persistence.
You have to persevere if there really is a market opportunity for you.
Right. But so there is a time to quit.
I think there is. If
And
the
what do you
dogs,
tell people when you're in your Stanford business graduate school class? When to quit?
when the dogs ain't eating the dog food,
Is that it? Is that simple?
and you just can't figure out how to get them.
So you change the dog food recipe 100 times over 2 years. The dogs still don't eat it.
You know, one of the biggest misperceptions, and one of the things that I most disagree with the way things are taught in business school, is that entrepreneurship is typically described as an entrepreneur looks at a market, tries to find a hole, and develops a product. those lead to what Howard Marks would call a right in consensus opportunity. They're too
Right.
easy to find. The non-consensus things are cases where, at least in technology, the entrepreneur sees an inflection point in technology, which allows her to create a new product. And then the question is, who cares? What's the market? So instead of starting with the market and finding the product, the really big winners start with a product and find a market. So you have to, the in vogue term is pivot.
Right.
But you're basically keeping the same technology to try to find a market.
Iterate.
Iterate. And if you can't find a new market for that technology, then I think you have to call it a day.
So mobile processors and screens, and you try to make a Newton, it's not ready, it fails. You try again 10 years later.
Or you try to figure out, is there a very small segment that will care deeply to get started? One of the biggest, yes, that's a perfect example. So one of the biggest mistakes, the biggest mistake that I saw entrepreneurs make when I was a venture capitalist is that they went after the large market first. Now, I just wrote a piece in Inc.com about the lost art of crossing the chasm. So in the 1990s, the most popular business book in technology was the book Crossing the Chasm.
Right. Define what that means for people who haven't read it.
In technology, as in most products, there is an adoption life cycle where typically products are initially bought by innovators, then early adopters, then the early majority, late majority, and laggards. And I'll explain what that means. The innovators are people who want to try everything, but they don't want to pay for anything. Samplers. In enterprise, it's a corporate research lab, and among consumers, it's gadget geeks.
Sure.
They'll buy one of everything just to try it.
Yep.
Early adopters are people who have a point of pain and are willing to buy a product if it solves that point of pain.
They'll overpay.
They'll overpay based on proof of concept. So if you can prove to me that it really will solve my problem, I'll buy it.
So an audiophile might be the first to buy a CD.
Correct.
Or a laptop by a traveling business salesperson.
Exactly. The early majority are the pragmatists. So whereas the early adopters are the visionaries, the early majority, which is, think of this as a bell curve. So now we're under the middle of the bell curve.
Right.
They're the biggest portion of the market. They only buy based on references.
So the sales guy who uses the laptop says, this is incredible. I can do work on the road, on the plane. You need to get one to their mom or cousin or the other person.
If there are
in the
a lot
office.
of people who are already using it to the point that you get references from multiple people.
So when the iPhone first came out, maybe I'll get it, maybe I won't. But when those 5 or 6 people tell you it's incredible, you buy iPhone 2.
Right.
Or iPhone 3.
Or iPhone 3.
Yeah.
Now, that is the big chunk of the market. The late majority, the people who only buy once something becomes the standard.
The laggards.
And then the laggards never buy.
The laggards never buy.
So
that's
they're
the
the
tail
late-
of the bell
that's
curve.
the tail of
Those
the
are
bell
the dumb
curve.
people.
The-
The bottom 15%.
I'll leave that to you.
I'll say that's
Now,
the dumb people.
by far, the biggest chunk of the market is the early majority, the pragmatists who only buy on references. So no matter how good your product is, they will not buy it because they're not going to buy based on proof of concept. They're only going to buy based on references.
Right.
And the biggest mistake that I see entrepreneurs make is they try to sell to the early majority first. They don't want to buy your product no matter how good it is.
You want the early adopters,
First.
which is the first, whatever that is, 5% of the curve.
And then as you build out what Jeffrey Moore, the author of Crossing the Chasm, calls the whole product, which are the additional interfaces, features, support from third parties, then you can cross the chasm from early adopters to the early majority.
Right.
So for us, we started with young people in tech who can't afford financial advisors, the minimums.
Right.
They're
But
the-
they're going to love it
They're going to love it.
and tell their brothers who are not in tech.
Exactly.
Or their mates from college.
Now, a lot of people think we're crazy. Why aren't we going after the big chunk of the market, given how low our fee is? Because they're not going to buy anyway until we have a minimum of $1 billion under management.
Yeah,
Unfortunately,
and-
we'll get there next year.
And you want those crazy early adopters to be absolutely in love with it. How do you know if they're in love with it or not?
If they open more accounts or add more money to their accounts or invite their friends. Those 3 things.
Right. And how do you know what features to add to get them to do that? I mean,
Well, we're big believers in the customer development process. It's part of what I teach in my product market fit
explain
class.
that, yeah.
So the idea is basically sell, design, build. Use the scientific method to build products, meaning you develop a hypothesis, you test the hypothesis of the product idea, and if prospects are willing to pay you for that, then you develop.
So you tell them, hey, we're thinking about making this. Would you pay for it?
Yes.
It's like the lean startup movement.
It's
See,
exactly the lean
What do you
startup.
think of the lean startup movement, the impact it's had? Is that wise to pursue that? Is it wise with these caveats?
I think it's phenomenal. I think it is just as crossing the chasm was a major step forward in the 90s for entrepreneurship. I think the lean startup methodology is a major step forward today. Now, will it make everyone a success? No.
Nothing
Because
can.
not every idea is great.
It
But
doesn't solve for that.
It doesn't solve for that, but it will minimize the amount of capital you need to get to success if you're going to be successful.
Business school worth it today?
You know, it depends. I think people go to business school for three reasons. First and foremost is to pivot their career. You know, if you're an accountant and you really want to work in high-tech marketing,
Yeah.
no one's going to give you that job.
Yeah, you're not going to get.
You're not going to get the job. But if you go to Harvard or Stanford, 2 weeks after you start your first year and you send your resume to the same people who wouldn't meet with you, you'll now get an interview.
Yeah,
it's
at
not
the very
fair.
least.
It's not fair,
But it's true.
but it's true. So I think
concur.
the biggest reason to go to business school is to pivot your career.
Okay.
Number two is the network that you build if you go to a good school. And boy, that served me unbelievably
Would you
well.
go Penn, Stanford,
I went to
Harvard?
Stanford for business school.
Got it.
And
But Penn undergrad?
Penn undergrad.
Got it.
And then the third reason is the education, is what you're
But
going
Wharton's
to learn.
a better school than Stanford, right? You would agree?
No.
I'm just joking. Well, Stanford versus Harvard.
Look, I
People
think
say
Wharton is
Stanford is better
wonderful.
than Harvard.
I-
But Harvard has a better reputation.
I think it depends. So if
explain.
you want to go into finance,
Yeah.
I think you want to go to Harvard.
Got it.
If you want to go into technology, you want to go to Stanford.
It's a very diplomatic. What's the third situation? So you had pivoting your career.
Yeah.
Second, the network.
And third is the education,
The actual knowledge.
the actual knowledge.
Now,
And honestly, most people go for 1 and 2.
right. Because the knowledge now is freely available on the web.
Exactly.
And in fact, Coursera and edX and what's the other one? Udacity
Yes.
are all taking the courses at Stanford and Harvard and MIT and
Well,
Berkeley.
as I
and
said,
putting
I'm
them
a
online.
trustee at Penn, and,
Yeah.
and I'm on the faculty of Stanford, and they were 2 of the 4 founding partners of Coursera.
Right.
So I was very involved with that.
And what do you think the impact of that will be on humanity? The fact that, it used to be, to sort of phrase it another way, it used to be people would say, well, I was held back because I couldn't get into Harvard. I was held back because I couldn't meet any angel investors. Well, now you have AngelList, Kickstarter, who are democratizing the funding marketplace. If you put a great idea up on Kickstarter, nobody knows who you are, where you're from, and you can take all the courses from Stanford and MIT for free and get a certificate? What? What impact is that going to have on society?
Well, I think it helps knowledge. It doesn't address the first 2 of the 3 reasons that one goes to business school. It's not going to help you pivot your career the same
no, I mean,
way.
if you think if somebody sees a Coursera or an edX, certificate on machine learning that you scored a 97 at home versus going to the school, do you think an employer will care?
Look, I think it's in the Christensen
Yeah.
sense, it's a disruptive technology. So I
Yeah.
think ultimately it's going to take a while to get there, and disruptive technologies tend to take longer, which is counterintuitive
Right.
than non-disruptive technologies. So ultimately it will get there, and I think that as we move to an information economy, people are going to need to learn how to write code or work in an environment where code is the primary value. And the only way they're going to do that is through things like Coursera and Udacity. So I think it can play an enormous role in retraining the population.
Interesting. Andy, this has been an amazing hour. I was just like, well, Wealthfront is very interesting, but God, your insights before and after the Wealthfront stuff are incredible as well. I mean, it sounds like a great project. Everybody check out Wealthfront. I'm going to go there and I'm going to drop 5 dimes, 10 dimes
you.
in there. I'm going to check it.
It's free.
No, I'm telling you right now, my poor broker at Alliance Bernstein poor Shane is like probably going to be like, but this will be good. I can negotiate fees now. Maybe I negotiate my fee down a little bit. But yeah, I do think that you're doing great work there. Congratulations on the great success there. I hear you got some big announcements coming up. So everybody go to wealthfront.com. What is the Twitter handle for Wealthfront?
At Wealthfront.
Oh, you got it.
Yeah.
Oh, usually it's like at wealthfront.com or
We're
what is it?
fortunate. It's such a bad name, actually, that it was easy to get.
That's a great name.
Well, try to say TH before an F 5 times fast.
Wealthfront. I am a professional broadcaster. I am now a professional broadcaster. I can do it. No, it's a great name. You thinking about changing it?
Well, no, we're not thinking about changing.
I own 20.com.
Yes.
So if you lowered it to 20 basis points, you could do 20.com.
Well, for many people, it is only 20 basis points when you factor in the 10K that we manage for free.
Exactly. Everybody go check out wealthfront.com, put in 5 dimes, and go see the magic. Everybody follow Andy on his Twitter account, A Rachleff. That's spelled ARACHLEFF. Andy Rachleff, thank you so much for being on the program.
Thank you.